This video is on the advanced concepts of long-term investing. I would like to think my grandfather would be satisfied with the progress we have made in these videos so far together. We have gone through a lot of information. If I repeat myself, it's because it is very important information. My goal is to write a straight-to-the-point tool that highlights all of the things necessary to make personal investment decisions the same way a hedge fund manager would manage his client's money. Use rules to manage your portfolio, not emotions. If you were to work at a bank and you were managing millions of dollars of money, you would follow set rules about how to operate. Professionals do not act on a hunch or a feeling about a stock. I like to think there are just two different categories of people in any market: smart money and speculative money. The stock market acts as a machine where the speculative or the uninformed people give their money to the smart or informed money. Let's get right into the tools you need to join the informed money category. Remember to take notes. Fundamental analysis. The search for the value of a share to find a share that is undervalued, growing earnings safely, rising in price, and buy when the market is rising. To make cash in any time frame, you need three things: a method, management of money, and managing ourselves. What are the most important rules to investing? Don't lose money. Always have a written entrance and exit strategy before you purchase a stock. Be aware of the market cycles and how this relates to the overall emotional state of the market. Be a contrarian, buy stocks when they are cheap and sell when everyone is buying. Buy stocks at a discount and hold for the long term. It's that simple. What is a smart investment? High-quality businesses that are undervalued and trading at a discount. Price is what you pay. Value is what you get. It is better to buy less shares of a high-quality business than buy a lot of shares of a poor-quality business. A strong business will do better over time. A poor-quality business could go bankrupt. Probability of making money. When you buy a stock, you have a 52% probability the stock price will drop in the short term. You have a 48% probability the stock price will rise. In the short term, the stock market is a voting machine. In the long term, the stock market is a weighing machine. We can use this to our advantage. The key to success is always having yourself in a position to buy stocks if the stock price does drop. Never sell the stock just because the price has dropped in the short term. Always have a plan for what to do if and when the stock of a position drops, such as capital on the sidelines, set aside for opportunities, or hedging a position. What are the rules to buying a stock? Always journal each trade's entry and exit criteria and note the reason for buying the stock. Do a discounted cash flow analysis, DCF, to determine if the stock is currently undervalued or overvalued. Go through the checklist depending on what type of stock it is and do a deep dive fundamental analysis of the stock. Businesses with profitable balance sheets and low to no debt are the types of businesses best suited to buy and hold long term. Always look at where the stock is currently trading before buying and note the ranges the stock has been trading in the last 3 months. Where is the price of the stock or index in relation to the 50-day moving average? If the stock drops to the 200-day moving average, I try to add a good portion to that position to lower my cost base. What are the rules for selling a stock? The first reason to sell a stock is if the stock has increased substantially and it's time to pull out the original capital invested in the stock to use for another investment. If the original analysis was somehow completely wrong, in which case you need to get better at researching the stock. If any of the original reasons the stock was bought change and the management strategy changes to something undesired, you have the option to not participate if you don't agree with the way the business is run. Overall questions about stocks and companies. Do I understand the business? Is it a great business? Gross margins, 60%. Return on invested capital, 10-12%. Free cash flow margin, 20%. Interest cover, 300%. You can find a benchmark of all the recent data on the companies in the stock market if you search for them on Google. Does this company have an actual moat? Don't like a stock just because it's cheap. Buy a better business. Is this company's moat shrinking or growing? Does the company have great management? Are they able and honest? What is their track record? What is the total addressable market? What kind of stock is it? What is the company's story? What success will they have on the bottom line? Will this work in a new market or a new location? What is the volatility of the stock? What are the risk factors for the company? What is the company's competitive advantage? Would I hold the stock for 5 years? If the stock price drops, would you buy more? What intellectual properties the company owns? What would be my exit strategy if I bought the stock? Why would I sell the stock? Is this company using large amounts of debt relative to its competitors? Can low-cost overseas competitors put this business out of business? Is this company's earnings currently at a peak? Is there some temporary tailwind to enhance profits? How to analyze a value stock? Revenue under 15% annually. What is the PE ratio, forwards and current? Is the current PE ratio under the industry standard? Is the balance sheet good, and is the company profitable? How much debt does the company have? Typically, we review the annual report instead of the quarterly report. Does the board of directors have talent, and do I agree with their business values? What institutions are invested in the stock? How to analyze a growth stock? There are a good amount of things to consider when buying a growth stock because these stocks can be potentially the most risky stocks because you're speculating if the company will be successful over the long term. Look for a company that is after a big total addressable market or big TAM. Do you understand the business model? Do you understand the risk factors to this business? Does the business have positive net income? Is the business profitable? Has net income grown in the past 3 years? Do they expect to grow net income in the next 3 years? Have they grown revenue the past 3 years? Where is the proof that the company can do this? Has revenue grown 15% in the previous years? Company must grow 15% in revenue, plus in the future years. The size of the industry that the company is after is 50 times the size of the company's actual revenue. Example, company generates 1 billion in revenue out of the 50 billion the industry is worth. Forward PE under 10-15, current PE 15-20. Look for a management team that has a strong reputation in pursuit of perfection and growing the business. Is the original founder still involved with things? Innovation is key. Strong balance sheet with a lot of cash or have the ability to raise capital. Can the company pay off its debts? No dividends in a growth stock. The money stays inside the company and used to scale the business. The main focus is growth. The vision of the company must be years ahead of its competitors. How will they execute this vision? Will the team meet expectations? Pay attention to the company's quarterly earnings reports. Are they meeting expectations and are they projecting growth in the future quarters? Have you read the 10K and the 10Q for the stock? Have you listened to the conference calls? Is there low to no institutional investors? Has Wall Street bought the stock yet? What intellectual properties does the company own and how much is it worth? How does the company return money to shareholders in the form of share buybacks? What is the employee stock compensation policy? Could you stick money in this stock and feel comfortable if you were forced to hold the stock for 5 years? Would you buy more of the stock if the price drops in the short term? How to value a dividend stock? Has the company increased dividends without any dividend cuts? Is the dividend growth rate 5% annually? Is the dividend yield at least 4%? What is the payout ratio and how long have they paid consistently? Price to cash flow, forward PE ratio 20-25, yield on cost, annual dividend price, company debt, revenue growth rate 5% or more annually. What's the total return? Let's talk about weighted dollar cost averaging from a prior video, because I believe this is something that must be fully understood for someone to really succeed at growing your money effectively. It's never fun to overpay for something. Compare buying stocks and index funds to buying gas for your vehicle. Depending on the time of year and a whole list of other reasons, the price of gas fluctuates. Sometimes gas prices are high and you dread filling your tank. Other times prices are low and you feel happy to fill your tank. This would be like filling your tank and extra tanks when the gas is cheap, like a hoarder. Over time, we consistently purchase a set dollar amount of a stock or index fund, reserving a remaining portion of capital saved per month. Deploy 70% of the income saved per month to purchasing stocks and saving the remaining 30%. When the stock price is trading below the 50-day moving average, Increase the set dollar amount or stock purchase by 10 to 15%. This strategy will lower the cost base over time and increase the return on capital, and also ensure you have capital to purchase stocks if there is a sudden unforeseen drop in the price of the stock. In fact, just assume there will be 2 or 3 times the price of the stock drop substantially under the 200-day moving average after you started your position. These are your golden opportunities to get the same business at some of the cheapest prices you will purchase the stock at. Always stay in a position to buy stocks, especially when it's trading cheap. Is it possible to manage risk when buying stocks? By diversifying into index funds and stocks in different industries, this will limit the volatility in your portfolio. Hedging on big position sizes in your portfolio is an insurance policy that allows you to make a profit if the stock price drops. This could be used to increase the position size while the stock is trading at the prices it fell to. Why is hedging important? It allows you to offset or take the opposite position that will gain in value as the position loses. This is protecting your capital if the stock price does drop. The profit from the hedge can be used to buy more shares as the price is low to increase your position size. How do we set this trade up? Buy a long put option. This is your insurance policy if the stock price drops. This is where you make a high profit on the trade. Set the trade up on a Monday and set the expiration date to Friday. Set the strike price 6 to 7% below the current share price. Sell a short call option covered call. The premium collected on the covered call will pay for the price of the long put option contract. Use the same expiration date as the put option contract. Set the strike price 6 to 7% above the current share price. Make sure the premium from the covered call covers the long put option contract. Assignment risk of this type of trade. If the price rises above the strike price of the call option, you will have to sell the 100 shares in the contract. Just buy the shares right back. Hedging is a crucial risk management strategy for investors to protect their stock portfolios against adverse market movements. Put options and covered calls are 2 popular instruments used for hedging purposes. Consider implementing a weekly hedging strategy for any stock you hold at least 100 shares of. Aim to execute these strategies every Monday, choosing an expiration of Friday. This timing proves particularly effective during moments when you anticipate the market might experience a downturn from its peak. By regularly applying hedging techniques, you can actively manage your portfolio's risk and potential losses, providing a proactive approach to safeguarding your investments. Remember to adapt your strategy based on changing market conditions and your investment objectives. Before implementing hedging strategies with real money, it's advisable to practice in a simulated environment to gain familiarity and confidence. Practicing in a simulated environment allows you to refine your skills, test different strategies, and gain valuable experience without risking actual capital. Treat your paper trading account seriously and approach it as if you were trading with real money to maximize the learning potential. With practice and patience, you can become proficient in hedging stock portfolios using put options and covered calls. Let's recap. I will quickly list all of the topics we touched on: fundamental analysis, the most important rules to investing, what is a smart investment, the probability of making money, rules to buying a stock, rules to selling a stock, overall questions about companies or stocks, how to analyze a value stock, how to analyze a growth stock, how to analyze a dividend stock, weighted dollar cost averaging, managing risk, hedging. Please like and subscribe for more videos, and remember to click the little bell icon for notifications for when I drop new videos on how I trade option contracts to generate income in a separate trading portfolio.